What we have done is this is live and it's here and it's now, and of course it's all about you and I. And what does that mean? It means about capital risk entry in case Google was to get slammed $70 or $80 like they did a year ago, is that we had to buy some of the April 590 put. They were retail up here on the highs now at $9 and some change. And our entry order on 15 is $3,800 on this side of the market. However, the lesson learned is for me to buy that protection, I have saved a whopping total. What we would like to show you that just back on 3/6 of 2012, this very same put option on Google was $22.60. Therefore, they had come down here, and there was a time that we had traded them, and that low was 266. But let's just figure 370. You were right around that 370 area on the high. So our purchase, and you can take a look, that this last high here was $9.10, and our cost on 15 put contracts is $3.80. The dollar cost capital risk from this period of 410, and let's make sure that you can understand that that high was $9.10, and our entry right there is $3.80. That means to buy that 590 put, because of our due diligence of waiting on the actual earnings reporting date for 2012 April, as a 1-year anniversary for Larry Page. However, the way that Wall Street has treated them unfairly is that they are due for a pop. However, we do have to calculate that we're able to get the risk at a discounted price. If you take the high over here at 22.60, that put option hit that high, it was inflated, it got deflated, and it ran back up from this period of they had a close of 330 and then popped to $9.10. Now, with the expertise, is the way that they have treated Google and Google earnings was 1 year ago when Page stepped in as the leader CEO of Google Inc. The earnings were good, and they punished the stock considerably. And so the perception was, well, they hire too many people, so therefore that cost is real high. So their output cost and their employee head count and all kinds of other things that people look at just were not acceptable to them, and so therefore they sold the stock way down. And that was 1 year ago. Now let us talk about this last quarter of 2012, when Google came out and they reported their earnings, and they wrote the things down that they needed to write down, but the stock dropped a lot. Now we know that, Europe is weak, and that's included in the bear case. That's their case. And revenues, however, what is the offset of these revenue streams that Google presents? Not only that, the lesson learned is that I am buying wholesale protection. And I had to buy it because I've always got to be on the other side of that market. And just in case all fails and these were to pop back up here, you never know what's going to happen in after hours. We're not counting on it, but we have to be in play. And if they pop up here on 15 put contracts, well, that covers a lot of cost to that other side of that long side trade. And the thing about it is, the long side of the trade, which we'll cover next, that would be the call side. It's about me buying that protection at the lowest wholesale discounted price at 9:01 a.m. Pacific Standard Time, 12:01 Eastern, 412, 2012. Not only that, MMT, that highs, they're running this thing up in anticipation. That could be a concern for the bulls because they're probably thinking that Google cannot get to 740 and 750 and 760. It can get there very easily based on the pass through of their overall systems. Is where do those revenues from those, okay, so from the development side of things that everyone didn't like before with the head count, they're going into many places now. Is the head count paying for itself? And that's going to be the key. And there's going to be lots of things that people are going to be looking at in these earnings. And one of the things that they don't like, and we always talk about the good things and the bad things. So in the bad case scenario, the way that they look at it is, hey, it's time to sell it. They've done this to this name every time, right back down to where we bought it every time. And we've always bought right down there, 565, 570 area, and taking it all the way up to 670, selling it short at 670, and bringing it all the way back down to 594, and then leveraging back up to that all-time high in the equity there in that last pass, right where we were getting out of that long position, right around that 557 handle. So the thing about it is, it's counted risk on the put side of the market. Yes, this is the lowest area today that we could have got those, and we did, because we don't know exactly 100% how that bigger investment community will review those earnings. We take a look that Google is worth at least $7.50 a share, okay? And the reason why is that their revenue streams will increase from those developments that their genius staff has been putting together to turn into profits. So you have to have some faith in the management, but the only reason why you're buying the protection is because of the way Wall Street reviews it and could sell it down. And we have to be prepared, and we made this put side of that transaction, and in the next series, because this, once again, we discounted the entry, and we took out many thousands of dollars. They were up here. If you had 15 contracts, if you had 10 contracts, that's 22,000. They're only worth 3,800 where I just purchased them. So I saved a lot of money. And I did. And I didn't buy them up here in the highs. No, we did not. We bought them here on the low, going right now at that print of 644.44 by 644.7 on the offer. That's the ask. That intraday high, 645.46, with a beautiful 635.96 closing price, where it said to buy it yesterday, with the low of that beautiful gap of 640.26, with a little over $5 and, well, it's 5.20 ratio from the bottom up of that gap. So there's a low, there's a high, and that brought the puts down, and that's when we were able to purchase those. Okay, and the markets are up very strong. They're anticipating a good earnings report. Fine enough. This is the update right here on this Google put option, and I'm going to do the call option. So the call option will be part one, and the risk management and the back end wholesale, taking out the dollar cost risk to the lowest price to the best of our ability with our expertise of removing the dollar cost risk, so that protection would become very discounted to our entry and our well-being.